Okay, so let's unpack this. I want you to picture a scenario.
All right, I'm picturing it.
You are running a massive industrial juggernaut. We are talking about a company that makes the heavy machinery that powers the world.
Motors, robotics, that kind of thing.
Exactly. Automation systems, the stuff that keeps the lights on and the assembly lines moving.
Right.
Now imagine your sales team is absolutely crushing it. I mean, they are on fire. They are selling way more units than they did last year.
Customers are lining up.
Customers are lining up. The order book is thick. By every conventional metric of popularity, you are winning.
It sounds like the dream scenario, honestly. I mean, usually in business, volume solves everything.
Yeah.
If you can just sell enough widgets, the rest takes care of itself.
Right. But then the year ends. December 31st rolls around. You get the report card. You sit down expecting to pop the champagne. You look at the bank account.
And there's actually less profit left over than there was the year before.
Exactly. When you were selling less stuff.
Yeah, that is the classic profitless prosperity. It is the absolute nightmare scenario that keeps CFOs awake at night.
For sure.
You are running faster, sweating more, and yet your bank account is shrinking.
And that is exactly the mystery we are looking at today for this deep dive. We have a single document in front of us, and it tells a really fascinating, honestly, slightly terrifying story.
It's the statement of consolidated financial results for ABB India Limited.
A heavy hitter in the industrial space.
Absolutely.
And just to set the context here, because context is everything, we are strictly looking at the figures for the quarter, and the full year ended December 31st, 2025.
So this is the fresh data. This is the 2025 wrap-up.
The ink is barely dry. And calling it a mystery isn't hyperbole, is it?
No, not at all. When you look at financial sheets like this, usually the arrows all point in the same direction.
Right.
If revenue is up significantly, profit is usually up significantly.
Yeah.
It's a correlation that business schools teach on day one.
Yeah, more money in, more money kept.
Exactly. But ABB India has posted a set of numbers here that forces us to ask a very uncomfortable question. Is growth always good?
That is the mission for this deep dive. We aren't just going to read rows and columns. We are going to play detective.
Follow the money.
We are going to find out where the money went because, spoiler alert, ABB India brought in over 1,000 crores in new revenue in 2025.
But their profit after tax actually dropped.
It's wild. So here is our roadmap for you today. We are going to break this down into 3 acts to keep it organized.
Sounds good.
Act 1 is the top line, the good news, the champagne moment. Act 2 is the middle, the expenses, or as I like to call it, the leak.
The leak, I like that.
And Act 3, the bottom line, what is actually left for the shareholders when the dust finally settles.
Sounds like a solid plan. Let's start with the good news.
Act 1, the top line. If I just handed you the top 3 inches of this sheet and covered the rest with my hand, you would think ABB India is having the best year of its life.
You absolutely would. Let's look at line 1, revenue from operations. This is the raw money coming in the door before a single bill is paid.
Just the sheer cash register receipts.
Right. For the year ended December 31st, 2025, that number is a staggering 13,200.73 crores.
13,200 crores. That is a massive number. But big numbers are just abstract without a comparison, right?
True.
How does that stack up against 2024?
It is a significant jump. In the previous year ending December 2024, revenue was 12,188.31 crores.
Okay, so if you do the math, we are looking at an increase of roughly 1,014 crores in a single year.
Let's pause on that for a second, because growing the top line by 1,000 crores is not easy.
No.
That's not just raising prices by 1% or 2%. That implies real volume.
A lot of extra motors and robots going out the door.
Exactly. It implies significant demand. And we can verify that by looking deeper into line 1A.
Sales of products and services.
Yes. This isn't interest income from the bank or side bets on the stock market. This is their core business.
The actual things they make.
Right. That specific line item jumped from about 12,087 crores in 2024 to over 13,065 crores in 2025.
Okay, so the core thesis of the business is totally intact. People want what ABB is selling.
Desperately. The market is hungry for automation and electrification.
Now, was this just a lucky start to the year? You know how sometimes you have a great Q1, you catch a big contract, and then things kind of fizzle out by Christmas?
No, and that is what makes this so interesting. The momentum actually held up right to the finish line.
Really?
Look at the first column on the left. The quarter ended December 31st, 2025.
Okay, looking at it.
This covers just the last 3 months of the year. They clocked 3,557.01 crores in revenue.
And how does that compare to the recent past? Just to gauge the momentum.
It is excellent performance. It beat the preceding quarter, September 2025, which was around 3,310 crores.
Okay.
But more importantly, it beat the same quarter from the previous year, December 2024, which was 3,364 crores.
Okay, so year over year, quarter over quarter, the sales machine is just firing on all cylinders.
Yes. We have growth on the annual basis, and we have growth on the quarterly basis.
Okay, so Act 1 concludes with the standing ovation. The sales team gets their bonuses, the marketing team high fives.
Champagne is flowing.
Exactly. If we stopped the deep dive right here, the headline would be ABB India smashes revenue goals.
But we can't stop here.
We can't.
Because revenue is vanity, profit is sanity. And this is where the plot really thickens.
Welcome to Act 2, the leak. We established they made over 1,000 crores more in sales. Basic logic, or at least simplistic lemonade stand logic, suggests that if I sell more lemonade, I should have more money in my pocket at the end of the day.
But that didn't happen here.
No, it did not. To understand why, we have to look at line 4, simply titled Expenses.
Let's pull that up.
I am looking at the total expenses for 2025. It is 11,325.15 crores.
Right. Now compare that to the total expenses in 2024.
Okay, that was 10,028.45 crores.
Whoa.
Yeah. Let me do some quick napkin math here. Revenue went up by about 1,014 crores.
And expenses.
Expenses went up by roughly 1,300 crores.
And there's your problem. You can see the mismatch immediately.
Yeah.
They spent about 1.30 to make 1.00 of new growth.
That hurts.
Mathematically, you're running faster just to fall behind.
But why? That is the burning question. Did they lose control of spending? Did they build some kind of golden headquarters, or is this something more systemic?
It is rarely the flashy stuff like golden headquarters. It is usually the boring stuff that kills you.
The invisible stuff?
Exactly. We need to look at line 4A. This is the single biggest number on the entire page.
Cost of raw materials, components consumed, and project bought-outs.
That's the one.
Project bought-outs. That is a bit of industry jargon. What does that actually encompass?
It is a mix. Raw materials are the basics. Copper for wiring, steel for casings, silicon for chips.
Sure.
Components or subassemblies they might buy from elsewhere. And project bought-outs usually refers to third-party items they buy to bundle into a larger project for a client.
Got it.
Essentially, this line item represents the cost of the physical stuff they sell.
The actual atoms? So what happened to that number?
It exploded. In 2024, this cost was 5,929.24 crores.
Okay.
In 2025, it ballooned to 6,648.87 crores.
That is huge. That is a nearly 720 crore increase just in materials.
Think about what that means. The revenue increased by 1,000 crores, and 720 crores of that.
Nearly 72%.
Exactly. 72% was immediately eaten up just by the rising cost of materials. That leaves very little room for everything else.
It implies that every widget they built cost them significantly more than it did the year before. Is this an inflation story?
It has to be. This tells us a story about global commodity prices. Copper, steel, semiconductors, these things have fluctuated wildly.
Right.
It tells us that while ABB India was able to sell more, they weren't able to pass on the full extent of those price hikes to the customer.
They absorbed a lot of that inflation.
Precisely. They took the hit on the chin to keep the sales moving.
And it wasn't just the raw manufacturing materials, right? Look at line 4B, purchases of stock in trade.
Yes, stock in trade. This is distinct from raw materials.
How so?
Stock in trade usually refers to finished goods they buy just to resell directly. Like a grocery store buying apples. They don't make the apple, they just sell it.
Ah, I see.
In ABB's case, this might be specific specialized equipment they import and sell to Indian clients.
And how did that fare?
Same story. It jumped from roughly 985 crores to 1,106.78 crores.
Ouch.
So whether they're making it themselves or buying it to resell, the cost of acquiring goods is going up significantly.
Okay, so the physical stuff got expensive, but what about the people making the stuff?
Right, the human element.
In a year of massive growth, usually you have to hire more bodies to move those boxes. I'm looking at line 4E, employee benefits expense.
This one is interesting, and it really mirrors the broader economic trends we see in tech and engineering right now.
Which is?
Well, it went from 821.93 crores in 2024 to 974.81 crores in 2025.
That is a jump of over 150 crores. That feels like a very big jump for one single year. Is that just purely hiring more people, or are we talking about raises?
The document doesn't give us a head count, but in this economic climate, it is almost certainly both. To support 1,000 crores in new sales, you need more sales staff, more engineers, more logistics people.
Obviously.
But there is also the retention aspect.
The talent war.
Exactly. If you want to keep your best electrical engineers from leaving to a competitor, you have to pay them more. Wage inflation is incredibly real, so costs are hitting them from every possible angle.
So you are getting hit on the price of the copper wire, and you are getting hit on the salary of the engineer wiring it.
It's double whammy. And then, just to twist the knife a little further, look at line 4H.
Let me find it. Ah, the catch-all bucket. Other expenses.
Right.
Other always sounds so small to me, like petty cash. But here it is, over 2,000 crores.
2,130.54 crores, to be exact, up from about 1,970 crores.
What's in there?
This is everything else. Power and fuel to run the factories, rent, marketing campaigns, travel costs, consulting fees. It all crept up.
So let's just recap Act 2 quickly, because this is really the crux of the whole deep dive.
Let's do it.
Raw materials, up massively. Stock purchases, up. Employee costs, up significantly. Other expenses, up.
There wasn't a single category where they saved money.
No. The leak was everywhere. The ship was taking on water from every seam.
Which brings us to the inevitable tragedy of Act 3.
The bottom line, this is where the rubber meets the road.
Let's look at line 5. Profit from continuing operations before tax.
This is the number before the government takes its slice. This is the pure operational result.
Exactly. For the year 2025, the profit before tax, or PBT, is 2,229.94 crores.
Okay. And for comparison, what was it in 2024?
In 2024, it was 2,513.26 crores.
Wow. That is a drop of nearly 300 crores.
Just let that sink in for a moment. Think about the effort involved. They worked their tails off to sell 10% more product.
They moved mountains of inventory.
They signed thousands of contracts. And the reward for all that extra effort was making roughly 12% less profit.
That has to be incredibly demoralizing for the management team. It is like running on a treadmill that's suddenly sped up. You're running faster, you're sweating bullets, but you look down and you're actually moving backward.
It highlights the extreme vulnerability of high-volume manufacturing businesses to margin compression.
Right.
If you have thin margins to begin with and input costs rise even a little bit, it wipes out huge chunks of profit. Here, costs rose way more than a little bit.
Now, usually when you make less money, there's one small, ironic silver lining. You pay less tax.
True.
Did that help them here? Line 6.
In a perverse way, yes. Line 6 shows tax expense. In 2024, they wrote a check to the government for roughly 630 crores.
Okay.
In 2025, that dropped to 521.62 crores.
Okay, so they saved about 110 crores in taxes.
Because they earned less. It cushions the blow to the final number, but nobody pops champagne because they paid less tax due to lower income.
Yeah, that is not a victory. That is a consolation prize.
Fair point.
So let's get to the number that the shareholders actually care about. The number they put in their pocket, the one that moves the stock price. Line 7, profit after tax, or PPAT.
The ultimate scorecard. For the full year 2025, ABB India took home 1,668.40 crores.
Yes.
Versus 1,874.67 crores in 2024.
So roughly a 200 crore drop in net profit. That is a substantial hit.
It is. It is a double-digit percentage drop in profitability during a year of double-digit revenue growth. That is a very difficult divergence to explain to investors on an earnings call.
And I want to zoom in on something you mentioned earlier about the momentum. We said revenue was really strong in Q4, but what about profit in Q4?
This is the most worrying part of the document for me, frankly. If you look at the quarterly breakdown, the first two columns on the left, the profit drop was really pronounced at the very end of the year.
Let's look at that. The quarter ended December 31st, 2025.
The profit for that single quarter was 434.32 crores. Compare that to the same quarter in the previous year, which was 531.91 crores.
That is a drop of almost 100 crores in just one quarter.
Exactly.
Wait, so half of the entire year's profit loss happened in the last 3 months?
Roughly, yes. And that is a crucial insight for you as a listener. It suggests the problem isn't getting better. It is accelerating.
The cost pressures were heavier in December than they were in January.
Yes, it is not a one-time blip that happened in March and went away. It is a trend they are carrying right into 2026.
They're entering the new year with a very heavy backpack of costs.
Exactly.
Now, I noticed a tiny little line item here, line 8. Discontinued operation. It shows a loss. I always wonder about these things. Did that drag them down?
Negligible. There was a loss of 1.52 crores for the year from discontinued operations.
Okay.
In a company dealing with thousands of crores, 1.5 crores is a rounding error. It is basically the change found in the couch cushions.
So we absolutely cannot blame the discontinued operations for the bad year.
Absolutely not. It is important for accounting accuracy, but do not let it distract you. The villain here is clearly raw material inflation. Line 4A is the culprit.
Okay, now before we close the book on the numbers, there is this section at the very bottom called Other Comprehensive Income, or OCI. Line 11.
Right.
Usually my eyes glaze over here because it gets very technical, but I actually see positive numbers. Does this change the story at all?
Don't let your eyes glaze over, because this actually helped them out. This is the fine print of finance. Line 11 mentions remeasurements of defined benefit, liability, or asset.
In English, please.
Okay. Broadly speaking, companies have future obligations to pay pensions and benefits to their staff.
Sure.
Every year, actuaries, the math wizards, recalculate how much money needs to be set aside for that today based on interest rates and life expectancy and other factors. Sometimes you have to set aside more, which counts as a loss. Sometimes you realize you have enough, or interest rates moved in your favor, and you actually book a gain.
And this year?
The math worked in their favor. For 2025, this resulted in a gain of 12.36 crores.
Hey, every crore counts when you are down 200.
Especially when you compare it to 2024, where this same line item was a negative 14.16 crores.
Oh, wow!
So year over year, that is a roughly 26 crore swing in their favor. It is not operational profit, but it is real value on the balance sheet.
So when you add that little actuarial bonus back to the profit, what do we get? Line 12. Total comprehensive income.
We end up with 1,677.51 crores for the year.
Which is still
trailing the previous year significantly. In 2024, total comprehensive income was 1,861.04 crores.
So no matter how you slice it, pre-tax, post-tax, with the actuarial bonus, without it, 2025 was simply less profitable than 2024.
Correct. The narrative is brutally consistent across every single metric. You can't massage these numbers to look like a win on the bottom line.
So what does this all mean for you listening? If you are trying to make sense of ABB India's health based on this one sheet, what is the big takeaway? Is the company in trouble?
I wouldn't say trouble. They are profitable, they are solvent, they are growing.
Right.
But the takeaway is that revenue does not equal success if your efficiency is under attack. ABB India proved something very important this year. They proved they can scale.
It did.
They proved they can grow the top line by double digits in a mature, competitive market.
Yeah.
That is the hard part for many companies, and they nailed it.
But
they are operating in a hostile cost environment. The narrative of this document is a constant struggle between scaling up and keeping costs down.
And in 2025, costs won the battle.
Costs absolutely won. The price of materials, the price of stock, and the price of talent all rose faster than they could manage.
It feels like a classic cautionary tale for any business owner listening. You can sell 13,000 crores worth of product, but if it costs you 11,000 crores to make it, your room for error gets very, very small.
Precisely. And looking at that quarterly trend where the Q4 profit was down nearly 100 crores compared to the prior year, it suggests the management team has a very specific job to do in 2026.
They don't need to worry about sales. Sales are great. They need to worry about line 4A.
Exactly. They need to stop the bleeding in raw materials. They need to either negotiate better prices with their suppliers, find cheaper alternatives or substitute materials, or, and this is the really hard one, raise their own prices.
That is the scary lever to pull, isn't it? If they raise prices to cover these costs, do they risk cooling off that red-hot demand they just built up?
That is the ultimate balancing act. Growth versus margin. This document shows us exactly how difficult that balance is to maintain in real time. If you raise prices, maybe revenue drops back down to 12,000 crores, but maybe profit goes up because your margin is finally better.
It is fascinating. We usually think of business as simply selling stuff, but this report shows that selling stuff is only half the battle. Buying the stuff you need to make the stuff you sell, that is where the war was lost this year.
Couldn't have said it better myself. It is a reminder that inflation isn't just a headline on the evening news. It shows up right here in black and white, eating away at the bottom line of even the biggest, most efficient companies.
So here is the provocative thought I want to leave you with today. If raw material costs, that massive 6,600 crore beast we looked at, continue to trend upward as they did in this report, can ABB India sustain this level of profitability just by selling more volume? Or are we going to see a fundamental shift in their strategy next year, where they are forced to hike prices on their customers to protect the bottom line?
I will be watching that Q1 2026 report very closely to find out. If they start prioritizing margin over volume, we will see it in the numbers immediately.
A fascinating look under the hood of a major industrial player. Thanks for unpacking it with me.
Always a pleasure to follow the money.
And thank you for listening to this deep dive. Until next time. Coils and then just launches itself across the room.
That is actually a surprisingly accurate physical metaphor for the financial chart we're looking at today.
Yeah, I thought so too. Welcome to today's deep dive. We are doing a granular analysis on a single but incredibly dense source today.
Very dense.
It's a daily candlestick chart for ABB India Limited on the National Stock Exchange, or the NSE.
Right.
We're tracking the price action from roughly November 2025 through to the present moment, which is late February 2026.
Yeah.
And honestly, this chart is a masterclass in market psychology.
It really is. I mean, it's rare to see all the classic phases of a market cycle compressed into just 4 months. We have the squeeze, the trap, the breakout, and what looks suspiciously like a climax right at the end.
Exactly. So our mission today isn't just to tell you that ABB stock went up. I mean, anyone with eyes can look at this image and see the rocket ship on the right side.
Right. The what is obvious.
Exactly. The what is obvious. We want to decode the how it happened. We're going to use the dashboard indicators visible on this chart, the Bollinger Bands, the RSI, the volume, to understand the story the money is telling us.
And specifically, why the most dangerous moment on this whole chart might actually be right now, when everything looks the absolute best.
Yeah, that's the scary part. Let's start at the beginning, though. The what we can call the boring phase. We're looking at the left side of the chart, roughly November 7th through the end of December 2025.
Visually, this is basically a flat line.
It's incredibly dull. The candles, those little red and green vertical bars representing the daily price movement, they're tiny.
It's very compressed.
Yeah, the stock is just shuffling sideways.
Yeah.
It's completely trapped in this box between the price of 47.70 and 53.83 on the y-axis.
In technical analysis, we call this phase consolidation. But the real story here isn't the price at all. It's the volatility, or rather the lack of it. Look at the green lines bracketing the price action.
Right, the Bollinger Bands.
Exactly. For those who might not stare at charts all day, let's unpack what those are. Bollinger Bands basically represent standard deviation.
Okay.
They show us how much the price usually moves away from the average. When the market is wild and emotional, the bands open up, they widen. But look at November and December here.
They're pinched so tight, they're running almost perfectly parallel to the price, just forming this super narrow channel.
That is the Bollinger Squeeze. It's one of the most reliable visual signals in trading because it relies on a fundamental truth about markets. Markets cycle between high volatility and low volatility, constantly. So when you see the bands get that tight, it tells us that volatility has dropped to historic lows. The market has found an equilibrium. Buyers and sellers agree on what ABB is worth.
But equilibrium in the stock market doesn't last forever, does it?
Never. The market breathes, it expands, and it contracts.
Right.
A squeeze like this is the market taking a deep breath and holding it.
Like the coiled spring.
Exactly like the spring. And usually, the longer the squeeze, the longer the market holds its breath, the more violent the exhale is going to be when it finally breaks.
And we can see that total lack of energy in the volume, too. I'm looking at the bottom panel of the chart now, the vertical bars showing how many shares are actually trading hands every day. It looks like a desert.
The volume is drying up. It's low and flat across the board. This is a crucial piece of the puzzle because it tells us the retail traders, the regular folks, the day traders, they're bored.
They've moved on.
Right. They've looked at ABB, seen it's not doing anything exciting, and they've walked away to find a stock that is moving.
But the institutions, the big money,
The smart money is likely quietly accumulating right here in this boring zone. Institutional investors actually love boredom.
because they can buy without moving the price.
Exactly. If they buy when it's volatile, they spike the price against themselves. Here, they're the ones coiling the spring. They are building a massive position while everyone else is asleep at the wheel.
So the spring is coiled, it's tight, it's ready to snap, and then the calendar flips to January 2026. And if you were holding this stock, betting on it to go up, you probably had a heart attack.
Oh, absolutely. This is phase 2, the trap. This is where the narrative gets really interesting.
Because it snaps downward
Oh,
hard. Right at the start of January, we see this series of big, aggressive red candles. It looks like the floor just completely falls out from under it.
this is a classic bear trap.
Hmm.
Technically speaking, it's a breakdown. You can see the price slices straight through the moving averages.
Those are the smooth red and green lines overlaying the candles, right?
Yes, the red line is the short-term trend, and the green line is the long-term trend.
I see that. The short-term red line actually crosses entirely below the long-term green line. That's usually a pretty bad signal to get out, isn't it?
It's called a death cross.
Sounds ominous.
It's meant to. Visually, it is terrifying for a retail investor. It signals that the immediate momentum is now significantly worse than the long-term trend. The price just crashes all the way down, slicing through support until it touches the bottom Bollinger Band, way down around the 41.57 level.
So if I'm an average guy holding the stock there, I'm panicking. I'm looking at this chart, and it looks like the company is collapsing. The chart is broken.
And that panic is exactly the point of the trap. This is where human psychology completely overrides logic. We need to look at the middle panel now, the RSI, the Relative Strength Index.
That's the jagged white line in the separate box in the middle.
Correct. It basically measures the speed and the magnitude of recent price changes. Think of the RSI like a rubber band attached to a runner. The scale goes from 0 to 100. During this January crash, watch what happens to that white line.
It plunges deep into the bottom of the box. It goes well below the 30 level.
Which puts it officially in oversold territory.
Meaning what, exactly?
It means the selling is totally irrational. It's too fast. Everyone who wanted to sell, or was scared into selling, has already sold. The sellers have exhausted their supply. The runner has sprinted too far, too fast in one direction, and the rubber band is stretched to its absolute breaking point.
So this is the paradox of technical analysis. The chart looks its absolute worst. You have a broken trend, a falling knife, a literal death cross, but the indicators underneath are actually screaming that this is a massive opportunity.
Precisely. The rubber band is stretched downward to its statistical limit. The weak hands, the people who got scared by the red candles, have panicked and dumped their shares for cheap. And who do you think bought them?
The same people who were bored in December. The institutions.
The smart money. They step right in. They absorb all that panic selling. They scoop up those shares at 41.57 because they know the value is there. And that absorption is what sets the stage for the reversal.
Which brings us to phase 3, the fun part. The rocket ship.
The V-shaped recovery. Late January through February.
It's startling how fast the trend flips. There's a specific moment, a specific candle in late January. It's a massive green bar that just swallows up all the losses from the days prior.
That's an engulfing candle. It completely overlaps the previous trading range, signaling a violent shift in power from sellers to buyers. But don't just look at the green body of the candle. Look straight down at the volume panel underneath it.
Whoa. Yeah, okay. That is a skyscraper.
That singular bar is the highest volume spike on the entire chart up to that point.
So why is that specific volume bar so important? We know the price went up. Isn't that enough?
Not at all. There is a golden rule in charting. Volume validates price.
Volume validates price.
Right. Imagine a car trying to push up a really steep hill. If the car is moving up, but you can hear the engine is barely revving, it's probably going to stall and roll back down. That's price moving on low volume. It's not sustainable. But here,
The engine is absolutely roaring.
the engine is roaring. So when you see a massive price surge accompanied by a massive volume spike, It means the big institutions are fully committed. They aren't just dipping a toe in the water to test the temperature. They are cannonballing into the pool.
They are looking at 41.57 and saying, this is too cheap. We are buying everything available on the market.
Yes. And that sheer buying power initiates the total trend change. Now look at what happens to the Bollinger Bands as we move into February.
In December, they were that tight, pinched tunnel.
And now,
They look like a trumpet blasting wide open. The mouth of the bands is huge.
that represents the violent return of volatility. But look really closely at where the green price candles are relative to those expanding bands.
They are literally sticking to the top green line. Day after day, they're glued to the upper ceiling.
We call that riding the bands. It is a state of extreme, almost euphoric momentum. The price is pushing against the statistical upper limit of where it, quote-unquote, should be day after day after day. It's a sign of a runaway bull trend.
And the moving averages fix themselves during this run, too. That short-term red line loops back around and crosses right back above the long-term green line.
The Golden Cross, the exact opposite of the Death Cross we saw in January. Now the wind is completely at your back. Every indicator on the dashboard is flashing green. The short-term average is acting like a trampoline, lifting the long-term average higher.
It's amazing how fast the narrative flips in the market. In just 4 weeks, ABB goes from being uninvestable trash to the absolute market darling.
That is FOMO in action, fear of missing out.
Oh, for sure.
The retail traders who panic sold at the bottom in January, they see this rocket taking off without them. They see it hit 5,000, then 5,500, and the pain of missing out becomes too much. So they rush back in to buy at much higher prices. And that retail volume just adds more fuel to the institutional fire.
But trees don't grow to the sky.
They do not. And that brings us to the most critical part of this entire deep dive. The real reason we are analyzing this specific chart today.
Phase 4, the climax. We need to zoom all the way in on the very edge of the data, February 19th through the 21st. The absolute present moment.
Let's focus on the raw numbers displayed at the top left of the source image. This is the OHLC data for the most recent trading session. Open, high, low, and close.
Okay, walk me through the anatomy of this specific day, because on the surface, just glancing at it, it looks like another solid green day. The close is 5,987, which is obviously higher than the open at 5,725. So the stock is up, win-win.
It is a green day on paper, but in technical analysis, it's not just about where you finish the day, it's about the journey the price took to get there. Look at the high for that day.
The high was 16,246.
Right.
That is a massive intraday swing.
It's roughly a 9% move in a single day. The buyers went absolutely manic at the opening bell. They pushed the price up through 6,000, smashed to 6,100, and drove it all the way up to 62.46.
But they couldn't hold that altitude.
No, they couldn't. The closest you said was 59.87. That means from the absolute peak of the frenzy, the price dropped back down by over 250 points before the closing bell rang.
And visually on the candlestick itself, that intraday drop creates that long, thin, vertical line sticking out of the top of the green body.
Yes, the upper wick. Or sometimes traders call it the shadow. That wick is a crime scene.
A crime scene. That's a bit dramatic.
Well, it's evidence of a slaughter. The bulls tried to push the price to the moon, and the bears stepped in at 62.46 and absolutely crushed them. That long upper wick represents pure price rejection.
Rejection.
It tells us that at the 62.46 level, there were suddenly no more buyers left, only sellers. The market tested that extreme high, decided it was entirely unjustified, and slapped the price back down.
So it's a failure to launch, or a failure to sustain the launch.
Exactly.
Yeah.
We call this specific candle shape a shooting star or a gravestone, depending on the exact nuance, but the underlying psychological message is identical. Exhaustion. The buyers finally ran out of ammo.
And to confirm that exhaustion, we have to look down at our truth teller again, the volume panel.
Look at the volume bar for this final, exhausting day.
It is the highest bar on the entire chart. It's way higher than the breakout volume in late January. It's higher than the panic selling volume.
Now think about what that means mechanically. We have record-breaking volume, maximum market effort, more money changing hands in this one day than ever before. But the price couldn't hold its high.
It's like flooring the gas pedal in your car while you're stuck in the mud. The engine is screaming, the RPMs are redlining, but the car isn't actually moving forward anymore.
That dynamic is called churning, and it is a classic textbook distribution signal.
Distribution meaning selling.
Smart selling. The smart money, the institutions who bought all those cheap shares at 41.57 back during the January panic, they're selling now. They are happily handing their expensive shares over to the latecomers who are buying into the FOMO hype at 6,200.
Wow, that sounds incredibly dangerous for the latecomers.
It is the trap snapping shut a second time.
Yeah.
The transfer of wealth is happening right in front of our eyes on this chart. The volume is astronomical on this last day because the smart money is unloading massive, heavy positions into the blind buying frenzy of the retail crowd.
And if we glance back at our dashboard, is the RSI giving us a warning siren here too?
The RSI is screaming at us. It's likely hovering way up above 75 or even 80 on the scale.
Overbought.
Severely overbought. Remember, during the January crash, the rubber band was stretched to the bottom. It was oversold. Now, in just 4 weeks, that pendulum has swung to the absolute opposite extreme. The rubber band is stretched as far up as it can possibly go.
Okay, let's synthesize all these visual cues for you listening. We have a near vertical price rally throughout February. We have the price extended dangerously far above its moving averages. We have an RSI that is completely overheated. And on the very last day of our data, we see a shooting star rejection candle with record-breaking volume, indicating that the buyers just slammed into a brick wall.
It is the visual definition of a blow-off top.
So, the million-dollar question. Does this mean ABB stock crashes tomorrow?
Not necessarily a crash. There's a saying. Markets can remain irrational longer than you can remain solvent. The momentum could push it up for another day or two. But it means the probability matrix has entirely shifted.
The risk-to-reward ratio.
Exactly. In January, down at 4,100, the downside risk was incredibly low and the upside reward was high. Now, up near 6,000.
Yeah.
The risk is astronomical and the reward is minimal. From a technical standpoint, we are expecting mean reversion.
Market gravity.
Exactly. Gravity always wins. The price is just too far away from its historical average. It's like stretching that rubber band too far upwards. Eventually, physics demands it snaps back toward the middle.
And what does that snap look like?
It might mean a sharp, painful drop back down to the moving averages. Or, if the company's genuinely strong, it might just mean the stock goes sideways for 3 months to let the moving averages catch up. It has to digest this massive move.
So if you're sitting at home holding ABB stock right now, that long upper wick on the last candle is a loud warning shot.
It's the market ringing a bell at the top of the mountain. It's essentially saying, the easy money has been made. Proceed with extreme caution.
You know, it's fascinating. When you first glance at a dense chart like this, it just looks like jagged lines. Random noise, a bunch of chaotic data points. But when you systematically break it down, when you read the squeeze, the trap, the breakout, and the climax, it's actually a perfectly logical story of human emotion.
That's exactly what technical analysis is. People think it's magic or reading tea leaves. It's not. It's just raw behavioral psychology mapped onto an X and Y axis.
We see the total boredom of November. We see the blind, irrational panic of January. And we see the sheer greed and FOMO of February.
And potentially, the deep regret of March.
Right, because if you were the guy who bought at the very top of that wick at 62246, you are already significantly underwater by the time the closing bell rang.
And that's the ultimate lesson here. The chart gives you the what. It tells you exactly what the herd is doing at any given moment, but it's up to you, the individual investor, to control the why. You have to use this data so you aren't the person panic selling the bottom and you aren't the person FOMO buying the top.
So to wrap this deep dive up, we've tracked ABB from the absolute doldrums to the stratosphere. We've decoded the Golden Cross and the Bollinger Band squeeze. But we are deliberately left with this massive cliffhanger.
The February 21st cliffhanger.
We have a close at 59.87, which is significantly lower than the extreme high of the day. We have massive institutional churn.
The stage is completely set for a showdown between the bulls and the bears.
So here is the final provocative thought I want to leave you with today. As investors, we are heavily conditioned to think that green is good and red is bad. A stock going up rapidly is winning.
But the internal mechanics of the chart tell a vastly different story.
The most dangerous moment for your portfolio wasn't actually the terrifying red crash in January. That crash was the gift. It was the entry point. The most dangerous moment is right now when the sky is completely blue and the rocket is flying high.
Because the higher the rocket goes, the thinner the oxygen gets. And looking at the exhaustion in that final wick, I think the passengers are really starting to struggle to breathe.
Is that final shooting star candle just the market taking a quick breath before pushing to 7,000? Or is it the very first crack in the ice before another brutal correction? The chart tells you exactly what happened up until yesterday, but it stubbornly refuses to tell you what happens tomorrow.
And that is the eternal puzzle of the markets.
And that's why we keep watching the charts. Thanks for diving in with us.
Always a pleasure.